What is a world order and why it always changes? A world order is not an abstract idea. It is a system, a framework, a set of rules, written and unwritten, that governs how countries deal with each other. There are internal orders within countries, constitutions, laws, institutions, and external orders between countries, treaties, trade agreements, monetary systems, security alliances. When these systems are stable, the world feels predictable. Trade flows smoothly, capital moves freely, currencies function reliably, and conflicts remain contained. But stability is never permanent. World orders change, and they almost always change after periods of major conflict. The American world order began in 1945. It was born out of war. After the devastation of World War II, the United States emerged as the dominant economic and military power. In 1944, representatives from 44 nations met in Bretton Woods, New Hampshire. There, they designed the new global monetary architecture. The dollar would become the world's reserve currency. It would be linked to gold. Other currencies would be linked to the dollar. And global institutions, the International Monetary Fund, the World Bank, would enforce the new system. This was not accidental. It was strategic. The country with the strongest economy, strongest military, and strongest financial markets would anchor the global system. And for decades, that system worked. The United States produced the largest share of global output. It dominated trade. Its capital markets were deep and liquid. Its military power secured global shipping lanes. Its currency was trusted. That trust became the foundation of the modern global economy. But before the American world order, there was the British world order. In the 1800s, the pound sterling was the dominant reserve currency. London was the world's financial center. The British Navy protected global trade routes. Before that, the Dutch guilder held reserve status. Amsterdam was the center of finance. Before that, Spanish silver. Before that, different empires under different structures. Each order felt permanent at its peak. Each eventually changed. The shift does not happen overnight. It unfolds in stages. First, the dominant power rises. It builds strong institutions. It invests in education. It innovates. It becomes competitive in global markets. Its share of world trade grows. Its currency becomes widely used. Capital flows toward it. Borrowing becomes easy. Confidence expands. Then, over time, subtle imbalances appear. Debt accumulates. Wealth gaps widen. Political divisions deepen. External rivals strengthen. These developments do not initially feel threatening. In fact, during the peak phase, prosperity can be extraordinary. Living standards rise, asset prices climb, credit expands, optimism dominates. But embedded within success are the seeds of strain. When an empire's currency becomes the global reserve, it gains what economists call an exorbitant privilege. It can borrow cheaply. It can run persistent trade deficits. It can finance military commitments around the world. Other countries save in its currency. This advantage sustains power beyond fundamentals. But it also encourages excess, because when borrowing is easy, discipline weakens. Eventually, debts grow faster than income. Eventually, domestic politics polarize over how to manage those debts. Eventually, rising powers challenge the incumbent. This is not about good or bad leadership. It is about structural dynamics. The big cycle of world orders typically spans 2 to 3 centuries. The Dutch cycle, the British cycle, the American cycle. Each rose from conflict, flourished in peace, accumulated excess, and faced decline as internal weakness met external competition. The transition periods are rarely smooth. They are often marked by economic stress, currency instability, political polarization, and, in some cases, war. Today, signs of transition are visible. Global debt levels are historically high. Internal political divisions in major powers are pronounced. External tensions between the United States and China are rising. None of these factors guarantee immediate collapse. But taken together, they resemble earlier transition phases. The purpose of studying these cycles is not to predict precise timing. It is to recognize patterns. Because when patterns repeat across 5 centuries, they deserve attention, and understanding where a country sits within the cycle may determine how well it navigates what comes next. The shock that changes everything, the pattern of collapse. There are moments in history when the ground shifts beneath the world, not gradually, not politely, but decisively, and almost always, unexpectedly. The times ahead will feel radically different from those most people have experienced, but they will not be new. They will be familiar to history, because history has seen this before, again and again and again. Over the last 500 years, the world has not moved in a straight line of progress. It has moved in cycles. The Dutch rose, the Dutch fell. The British rose, the British fell. The United States rose, and now shows signs of late cycle strain. Meanwhile, China rises. This is not ideology. It is pattern recognition. The most important events in global history tend to surprise those living through them, not because they are unprecedented, but because they have not happened within living memory. And when something hasn't happened in living memory, people assume it cannot happen again. That assumption has always been wrong. In 1971, the United States effectively defaulted on its monetary promises. It did not announce it that way. It did not use the word default. But functionally, that is what happened. The global monetary system at the time was built on gold. Paper dollars were claims on gold. And when too many claims were issued relative to the gold available, the system broke. On August 15, 1971, President Nixon suspended the convertibility of dollars into gold. With that decision, the post-war monetary order changed. The dollar was no longer tied to hard money. It became a fiat currency, backed not by gold but by trust. Most expected financial chaos the next morning. Instead, the stock market surged. Why? Because breaking the gold link allowed the United States to print money more freely. More dollars entered the system. Asset prices rose, and a new phase of monetary expansion began. This had happened before, in 1933, and it would happen again in 2008, in 2020, and likely again in 2026 and beyond, should crisis conditions demand it. The lesson is not about gold, it is about structure. When governments spend far more than they collect in taxes, when debt burdens grow beyond what can realistically be repaid, when economies slow under that weight, they do not default in the traditional sense. They print, they always print. And printing redistributes wealth, from holders of currency to holders of assets. This principle is ancient, from Roman coin debasement to revolutionary France to Weimar Germany, to modern quantitative easing programs. The mechanics are different, the pattern is identical. To understand what is coming next, one must understand what has happened before, because monetary events do not occur in isolation. They are part of something much larger. They are symptoms of shifting world orders. And when monetary systems begin to strain, it is often because the deeper structure beneath them is already changing. That deeper structure is what drives the big cycle, and once seen clearly, it cannot be unseen. The big cycle, how empires rise. Every great empire begins the same way, with conflict, not minor disagreement, but decisive struggle, a revolution, a war, a restructuring of power. Out of that conflict, a new leadership class emerges, stronger, more disciplined, more unified. The rise phase of the big cycle begins immediately after this consolidation. And it always follows a recognizable sequence. First, the new leaders secure power. They gain broader support than their rivals. They eliminate or neutralize opposition. They create internal stability. Without internal unity, no empire rises. Second, they build institutions. Strong legal systems, clear property rights, reliable courts, functional bureaucracies. Institutions outlive individuals, and empires are built on institutions, not personalities. Third, they invest in human capital. Education becomes central, not just technical training, but discipline, work ethic, respect for law, and shared values. In the Dutch Republic during the 1600s, literacy rates were among the highest in Europe. In Victorian Britain, education expanded alongside industrialization. In the early 20th century, the United States led in university research and scientific innovation. Education leads to innovation. Innovation leads to productivity. Productivity leads to competitiveness. This is not abstract theory. It is measurable. As education improves, new technologies emerge. As technologies emerge, industries develop. As industries develop, exports grow. And as exports grow, trade expands. When a country becomes a dominant trading power, it must protect its trade routes. So military strength increases. Navies expand. Supply chains are secured. Global influence grows. The Dutch built ships capable of global voyages and created the Dutch East India Company. The British followed with industrial manufacturing and the British East India Company. The United States industrialized rapidly, developed mass production, and built a global military presence after World War II. Economic power and military power reinforce each other. Meanwhile, financial systems mature. Savings are converted into investments. Bond markets develop. Stock exchanges form. Capital flows efficiently toward innovation. Amsterdam became the world's financial center during the Dutch rise. London held that position during the British era. New York assumed it during the American century. Financial centers do not emerge randomly. They arise where trust, liquidity, and opportunity converge. As trade expands and financial markets deepen, the country's currency becomes widely used. Foreign merchants settle accounts in it. Foreign governments hold reserves in it. Its bonds become the preferred store of wealth. That is how a reserve currency is born. The Dutch guilder, the British pound, the US dollar. Reserve currency status creates extraordinary advantages. It allows the empire to borrow cheaply. It allows persistent trade deficits. It attracts global savings. It amplifies power. This stage often feels permanent. Prosperity rises. Confidence grows. Global influence expands. And because the system appears stable, borrowing increases. Businesses borrow to expand. Consumers borrow to consume. Governments borrow to fund projects and defense. As long as income grows faster than debt, the system strengthens. This is the virtuous cycle of ascent. Strong education leads to innovation. Innovation leads to productivity. Productivity leads to trade dominance. Trade dominance supports military power. Military power protects trade. Financial strength amplifies it all. Each factor reinforces the next. But embedded within this virtuous cycle is a subtle shift. Success changes behavior. Rising empires are disciplined. Mature empires are comfortable. And comfort alters incentives. During the rise, competition is fierce. During the top, confidence is assumed. That difference matters. Because while the leading power enjoys prosperity, other nations study it. They copy technologies. They adopt similar financial systems. They educate their own populations. Over time, they close the gap. History shows that no empire maintains its competitive edge indefinitely. The seeds of decline are planted during success, but decline does not begin immediately. There's a long plateau at the top, a golden era. For the Dutch, it was the 17th century. For Britain, the Victorian era. For the United States, much of the late 20th century. These are periods of wealth, cultural influence, and apparent stability, and they feel permanent while they last. But cycles do not stop at the top. They turn. And when they do, the forces that once reinforced strength begin to reverse. That is where the next phase begins. The top, when success plants the seeds of decline. Every empire reaches a point where it appears unstoppable. Its economy is large, its military is dominant, its currency is trusted, its financial markets are deep and liquid, its influence feels permanent. This is the top phase of the big cycle. And paradoxically, this is where decline quietly begins. At the peak, most of the strengths built during the rise are still intact. Education is strong. Innovation remains robust. Trade networks are vast. Capital flows easily. But subtle shifts begin beneath the surface. As countries grow wealthier, they also grow more expensive. Wages rise. Living standards increase. Costs climb. At the same time, other nations, once less developed, study the leading power. They adopt its technologies. They train their populations. They replicate its production methods. This reduces the leader's competitive advantage. The British copied Dutch shipbuilding designs. Later, Germany and the United States copied British industrial methods. More recently, China studied American manufacturing and supply chain systems. Technology spreads, efficiency spreads, advantage narrows. Meanwhile, prosperity changes behavior. During the rise, citizens tend to be disciplined, ambitious, and hungry for advancement. During the top, comfort increases, risk tolerance falls, leisure expands. Values gradually shift from production to consumption. This is not moral judgment, it is historical observation. The golden age of the Dutch Republic was marked by immense wealth and cultural flourishing. The Victorian era in Britain symbolized industrial dominance and imperial confidence. Late 20th century America experienced rapid asset growth, financial innovation, and rising global consumption. These eras were extraordinary. But prosperity also alters incentives. When incomes rise, borrowing often increases. Confidence in continued growth encourages leverage. Households borrow against future income. Corporations expand using debt. Governments run persistent deficits. As long as growth continues, debt appears manageable. Asset prices rise, credit expands further. Financial markets boom. Eventually, this expansion produces a bubble, and bubbles always share common characteristics: excess borrowing, speculative behavior, asset prices detached from fundamentals. The Dutch experienced financial stress during the Fourth Anglo-Dutch War. The British accumulated massive debts during World War I and World War II. The United States has gone through repeated debt-driven booms and busts since the 1990s, including the dot-com bubble, the 2008 housing crisis, and the pandemic-era monetary expansion. Each time, debt levels climbed higher. Each time, central banks intervened with stronger measures. At the same time, wealth becomes increasingly unevenly distributed. Asset inflation benefits those who own financial assets. Wages often lag behind asset growth. The gap between the wealthy and the rest widens. Wealth gaps are not merely economic, they become political. The haves seek to preserve their position. The have-nots demand redistribution. As long as overall living standards rise, resentment remains manageable. But when growth slows and debt burdens weigh on the economy, and opportunities feel constrained, political polarization intensifies. This is another hallmark of the top phase. Internally, unity weakens. Externally, rising powers observe. Because while the dominant empire enjoys prosperity, rivals are ascending. The rising power often has lower labor costs, higher savings rates, greater industrial focus. It accumulates strength quietly. In the late 19th century, Germany rose rapidly relative to Britain. In the late 20th century, China began rising relative to the United States. The pattern is familiar. The dominant power grows more indebted. The rising power grows more productive. At the same time, the privilege of issuing the world's reserve currency begins to distort incentives. Because global demand for the currency allows the empire to borrow easily. Trade deficits persist. Foreign nations lend back their savings. Consumption exceeds production. Over time, the empire becomes a net debtor to the rest of the world. This dynamic began for the United States in the 1980s. It occurred for Britain earlier. It occurred for the Dutch before them. Borrowing sustains power beyond fundamentals. But it also masks structural erosion. The cost of maintaining global commitments rises. Military spending expands. Overseas obligations accumulate. Eventually, the expense of defending the empire exceeds the economic benefit it generates. At the top, strength still appears visible, but fragility increases beneath the surface. Debt grows, inequality widens, political unity weakens, external competition intensifies. These forces do not collapse the system immediately. They accumulate, quietly, gradually, until an economic downturn exposes the imbalance. And when that downturn arrives, the decline phase begins. The decline, debt, division, and devaluation. Decline rarely begins with a single dramatic event. It begins with imbalance. Debt grows larger than income. Spending consistently exceeds revenue. Confidence weakens quietly before it breaks visibly. In the decline phase of the big cycle, the financial bubble eventually bursts. When debt levels become extreme, even a modest economic slowdown creates stress. Tax revenues fall, borrowers struggle, asset prices weaken, and suddenly the system that appeared stable reveals its fragility. At that moment, the empire faces a choice: default or print. Historically, default in nominal terms is rare for dominant powers. Instead, they choose devaluation. They print money. At first gradually, then aggressively. Printing money relieves immediate pressure. It allows governments to fund deficits. It supports asset prices. It stabilizes banks. But it does not eliminate the underlying imbalance. It redistributes it. When currency supply expands faster than productivity, purchasing power declines. Prices rise. Asset values inflate. The value of cash erodes. This process unfolded in the Dutch Republic after its costly wars with Britain. It unfolded in Britain after World War II, when war debts forced repeated devaluations of the pound. It unfolded in the United States after 1971, when the gold link was severed and monetary expansion became unconstrained. It unfolded again in 2008 and 2020, when central banks expanded their balance sheets dramatically. Each intervention delayed immediate collapse, but each increased long-term debt burdens. Debt does not disappear. It is either repaid, defaulted on, or inflated away. Most often, it is inflated away. At the same time, domestic conditions deteriorate. Economic hardship intensifies political division. When growth slows and living standards stagnate or fall, resentment deepens. The wealth gap becomes politically explosive. The have-nots demand redistribution. The haves resist. Political polarization intensifies. Populist movements emerge. Trust in institutions erodes. Democratic systems struggle to manage conflict. This dynamic is not new. It occurred during the late Roman Republic. It occurred before the French Revolution. It occurred in Russia in 1917. It occurred in Germany in the 1930s. When economic pain converges with political division, internal conflict rises sharply, and while the dominant power struggles internally, external rivals grow bolder. Rising powers observe weakness. They increase military spending. They challenge trade dominance. They form new alliances. The declining empire faces difficult choices: retreat and concede influence, or confront and risk costly conflict. Neither option is painless. The cost of defending global dominance becomes heavier as finances weaken. The United States has spent trillions of dollars. Britain faced similar pressures as it attempted to maintain its empire after World War I. The Dutch experienced repeated wars. In each case, military spending accelerated financial strain. Meanwhile, foreign holders of the empire's currency and debt begin to reassess. If confidence falters, they sell. When reserve currency holders begin to reduce exposure, borrowing costs rise. The currency weakens further. This marks a critical turning point. Of the roughly 750 currencies that have existed since 1700, the vast majority no longer exist, and all that survived were significantly devalued. Reserve currency status does not guarantee permanence. It only delays adjustment. Decline often unfolds slowly, then suddenly. Gradual erosion builds for years. Then, a crisis forces rapid restructuring. At that point, the old order gives way. Out of internal conflict and external competition, new winners emerge. Debts are restructured. Political systems adjust. A new world order forms. And the big cycle begins again. The pattern is not fatalistic. It is historical. Understanding where a nation sits within this cycle does not predict exact timing, but it clarifies direction, and direction determines preparation. Where we stand in 2026. Understanding the big cycle is one thing, placing the present within it is another. So where do we stand in 2026? The answer requires separating emotion from structure. First, debt. Global debt levels today are historically high relative to economic output. Major developed nations consistently spend more than they collect in revenue. Budget deficits have become structural. In prior cycles, persistent deficits at the top phase were an early sign of maturity transitioning toward strain. Second, monetary policy. Central banks dramatically expanded their balance sheets after 2008 and again in 2020. Interest rates were pushed to near zero in some regions, below zero. Large-scale asset purchases followed. These actions prevented immediate collapse. They stabilized markets. But they also increased systemic leverage. When debt grows faster than productivity, long-term flexibility narrows. Third, internal political division. Across major economies, political polarization has intensified. Wealth gaps remain wide. Cultural and ideological divisions are sharper. Such divisions tend to widen during late cycle phases when economic growth slows. This does not automatically lead to revolution, but it does reduce unity, which is essential during external competition. Fourth, external rivalry. The most significant geopolitical shift has been the rapid rise of China. China's economic output rivals that of the United States. Its share of global trade has expanded dramatically. Its technological capabilities have advanced. Its military spending has grown steadily. This dynamic mirrors earlier transitions. Britain rose while the Dutch declined. The United States rose while Britain weakened. Now, a similar duality exists between the United States and China. This rivalry is not solely military. It is technological, financial, industrial, currency-based. The world today is more interconnected than in any previous cycle. Supply chains span continents. Capital moves instantly. Information spreads globally in seconds. This interdependence makes conflict more complex, but it does not eliminate structural competition. Fifth, reserve currency dynamics. The US dollar remains the dominant reserve currency in 2026. Global trade is largely invoiced in dollars. US Treasury markets remain deep and liquid. But the share of global reserves held in dollars has gradually declined from its peak decades ago. Alternative payment systems are being developed. Regional trade agreements are expanding. These are not signs of immediate collapse. They are indicators of gradual diversification. In previous cycles, reserve currency transitions unfolded over decades. The guilder declined before yielding to the pound. The pound declined before yielding to the dollar. Such transitions are rarely abrupt at the beginning. They begin with incremental shifts. Finally, internal resilience, education, innovation, entrepreneurship, and capital markets remain strengths. These are powerful stabilizers. The big cycle is not destiny, it is a framework. Cycles can be extended, declines can be moderated, but structural imbalances cannot be ignored indefinitely. In 2026, the global system exhibits characteristics of a mature phase: high debt, heavy reliance on monetary intervention, rising internal division, growing external competition. None of these guarantee imminent crisis. But together, they resemble conditions that have preceded transitions in the past. History does not repeat exactly, but it rhymes consistently. The question is not whether the current order will change. All orders eventually do. The question is how prepared institutions and individuals are for adjustment. And preparation begins with recognition. Can decline be reversed? History shows that decline is common. It does not show that decline is irreversible. Empires weaken. Some collapse rapidly. Others stabilize, adapt, and extend their longevity. The big cycle is powerful, but it is not mechanical destiny. Reversal depends on choices, and choices depend on leadership, institutions, and collective discipline. There are two fundamental levers that determine whether decline accelerates or stabilizes. First, financial discipline. Every successful rise began with a country earning more than it spent. Productivity exceeded consumption. Savings funded investment. Investment increased output. Output strengthened currency credibility. The reverse is equally true. When spending persistently exceeds production, debt accumulates. When debt accumulates beyond sustainable levels, flexibility disappears. Reversal requires restoring balance. That means raising productivity, controlling deficits, improving competitiveness. These are difficult choices because they often involve short-term sacrifice for long-term stability. Historically, nations that corrected fiscal imbalances early avoided deeper crises. Those that delayed adjustment were forced into harsher restructurings later. Second, cohesion. Internal division accelerates decline more than external pressure. When societies fragment along economic, political, or cultural lines, collective problem-solving weakens. Polarization paralyzes reform. Extremism replaces compromise. History shows that the greatest threat to dominant powers often comes from within. The late Roman Republic weakened long before external invasions completed the fall. Pre-revolutionary France was divided internally before collapse. Even the British Empire faced internal political strain as its global power waned. Reversal requires restoring trust in institutions, trust in elections, trust in courts, trust in financial systems. Trust is not built through rhetoric. It is built through fairness, transparency, and results. There are measurable indicators of resilience: education quality, innovation rates, infrastructure investment, demographic vitality, capital formation. Countries that invest in these strengthen their long-term trajectory. In 2026, major powers still retain immense productive capacity. Technological innovation continues. Entrepreneurship persists. Human capital remains deep. These are stabilizing forces. But without discipline and cohesion, even strong foundations can erode. Reversal is difficult because late-cycle societies are accustomed to comfort. Reform requires confronting excess, reducing leverage, accepting slower growth temporarily. These decisions are politically challenging, which is why decline often continues until crisis forces action. Yet history also provides examples of renewal. Post-war Germany rebuilt through structural reform. Japan restructured after World War II. The United States rebalanced in the early 1980s after high inflation. None of these adjustments were painless, but they extended stability. The most important war an empire fights is often not external. It is internal, a battle between discipline and complacency, between long-term sustainability and short-term comfort. Reversal does not require perfection. It requires recognition of imbalances, recognition of trends, recognition that cycles operate regardless of ideology. The future is not predetermined, but the path narrows as imbalances widen. In the end, sustaining power comes down to two simple principles: earn more than you spend, and maintain unity. All other strengths, education, innovation, military capacity, financial markets, depend on those two foundations. Empires that maintain them endure longer. Empires that neglect them accelerate their decline. The big cycle is powerful, but it is influenced by choices, and those choices are being made now. The big cycle operates at the level of nations, but its consequences are experienced by individuals. World orders shift, currencies adjust, debt restructures. Households and investors must navigate the transition. The question is not whether individuals can control the cycle. They cannot. It's how they position themselves within it. History offers several consistent lessons. First, understand the difference between nominal and real value. When governments expand money supply to relieve financial stress, asset prices often rise. Stocks climb, real estate appreciates, commodities strengthen. At first glance, this appears to be prosperity. But if currency is being devalued, rising prices may simply reflect declining purchasing power. In 1971, after the dollar was detached from gold, markets surged. In 1933, after Roosevelt restructured the monetary system, asset prices rose. In 2008 and 2020, after central banks intervened aggressively, markets recovered rapidly. Monetary expansion supported asset values. The lesson is structural. When debt burdens are high and crisis emerges, authorities print. Hard assets tend to benefit relative to cash. Second, diversification across asset types and currencies reduces vulnerability. Reserve currency transitions unfold gradually. Holding exposure to multiple systems reduces risk. The Dutch guilder lost dominance slowly. The British pound declined over decades before yielding fully to the dollar. Transitions provide time, but only to those who recognize them. Third, productivity matters more than prediction. Trying to time macroeconomic inflection points is notoriously difficult, but investing in skills, education, and adaptability is consistently beneficial. Productive and flexible individuals navigate transitions better. Doctors, engineers, builders, innovators, their relevance persisted across monetary systems. Skill is not subject to devaluation. Fourth, discipline outperforms complacency. Late cycle environments often create illusions of permanence, easy credit, rising asset prices, low volatility. These conditions encourage over-leverage. History shows that excessive leverage magnifies downside when cycles turn. Maintaining margin of safety in finances and decision-making has always been a stabilizer. Fifth, emotional control is strategic advantage. Transitions generate fear and euphoria. Both distort judgment. Studying history tempers reaction. When one recognizes that cycles repeat, surprises become less shocking. Preparation replaces panic. Understanding does not eliminate volatility, but it reduces vulnerability to it. Finally, recognize that systems evolve. The next world order will not mirror the previous one exactly. Technologies differ. Institutions adapt. Digital currencies, artificial intelligence, and decentralized finance are modern developments layered onto ancient patterns. But the underlying dynamics, debt, productivity, power, trust, remain unchanged. Individuals cannot stop cycles, but they can align with durable principles. Maintain balance between spending and saving. Invest in productive assets. Preserve flexibility. Prioritize education. Treat risk with respect. These lessons are not dramatic, they are consistent. Across 500 years of rises and declines, those who understood structure navigated change more effectively than those who assumed stability was permanent. The big cycle is not a prophecy, it is a pattern. and patterns reward those who observe them calmly. When people hear the word decline, they often imagine catastrophe, collapse, currency failure, war, systemic breakdown. History shows that such outcomes are possible. But it also shows something more nuanced. Transitions do not always require collapse. They require adjustment. The big cycle describes recurring patterns of rise and decline. But decline does not necessarily mean disappearance. It often means relative repositioning. The Dutch did not vanish after losing global dominance. The British did not cease to exist. After the pound lost reserve status, their influence diminished, their economic structures adjusted. But they remained advanced, prosperous societies. The question facing major powers in 2026 is not whether change is coming. Change is constant. The question is whether adjustment can occur without rupture. There are structural pressures in place: high debt levels, aging demographics in developed nations, rising geopolitical rivalry, technological disruption. Each of these creates strain. But strain does not automatically equal collapse. Transitions unfold along a spectrum. On one end, peaceful restructuring. Debt renegotiated gradually. Currency dominance slowly diversified. Trade relationships rebalanced. Internal reforms implemented. On the other end, disorder. Rapid capital flight. Currency devaluation spikes. Political fragmentation. External conflict. The outcome depends on coordination and discipline. Historically, peaceful transitions are rare but not impossible. The shift from British to American dominance, while influenced by war, did not result in the complete destruction of Britain's internal order. It was painful, but not annihilating. The post-1971 transition from gold-backed dollars to fiat currency did not collapse the United States. It altered the monetary system, but institutions adapted. The current phase appears to be one of gradual multipolar adjustment. China's economic influence is expanding. Regional trade blocs are strengthening. Technological sovereignty is becoming a strategic priority for many nations. The dollar remains dominant, but its exclusivity is gradually narrowing. This does not imply imminent displacement. Reserve currency transitions historically unfold over decades. Confidence erodes incrementally. Diversification increases gradually. Only later, if mismanaged, does stress accelerate. The key variables to monitor are measurable: debt-to-income ratios, currency reserve composition, internal political stability, military escalation risk, productivity growth. These are the vital signs of an empire, like health metrics for a person. No single indicator determines outcome, but trends matter. In 2026, the global system reflects maturity rather than infancy. That maturity comes with both strength and fragility. Strength in institutional depth, technological capability, and capital markets. Fragility in debt accumulation, political division, and geopolitical tension. The future is unlikely to resemble a dramatic overnight collapse. It is more likely to resemble extended adjustment, periods of volatility, moments of tension, policy shifts, economic realignments. History suggests that cycles turn gradually, until they do not, but the speed of turning is influenced by decisions. Fiscal discipline can slow decline. Institutional reform can rebuild trust. Diplomatic coordination can reduce external risk. Ignoring imbalances accelerates stress. Addressing them moderates it. Transitions without collapse are possible. They are simply more difficult than denial. The big cycle does not dictate a singular outcome. It highlights probabilities, and probabilities shift with behavior. The coming years may feel unfamiliar, but unfamiliar does not mean unmanageable. Understanding the pattern reduces fear. Preparation reduces vulnerability, and perspective reduces overreaction. World orders change, they always have. The goal is not to prevent change, it is to navigate it wisely. The end of one cycle, the beginning of another. Every cycle feels permanent while it is unfolding. Every dominant power believes its system is uniquely durable. And yet, across 500 years of recorded global history, no empire has remained at the top indefinitely. The Dutch era passed, the British era passed, the American era rose, and now it enters a more complex phase. This is not a prediction of collapse, it is recognition of pattern. The end of a cycle is not an extinction event, it is a transition. Power redistributes, influence rebalances, currencies adjust, institutions reform, sometimes peacefully, sometimes violently, but always structurally. The defining feature of a changing world order is not chaos, it is reorganization. Old arrangements become unsustainable, new arrangements emerge. The process can be slow, then suddenly fast. For individuals living through it, the challenge is psychological as much as financial. It requires accepting that stability is conditional, that prosperity requires maintenance, that debt must eventually be reconciled, that unity matters. In 2026, the global system stands at a crossroads defined by measurable realities. Debt levels that are historically elevated, reserve currency dominance that remains strong but gradually diversifying, technological competition intensifying between major powers, internal divisions, testing institutional resilience. These conditions mirror earlier late cycle phases. But history does not mandate disaster. It mandates adjustment. The big cycle is not fatalistic. It is diagnostic, like a physician reading vital signs. If education weakens, productivity declines. If debt rises too fast, financial fragility increases. If political division intensifies, cohesion erodes. If external rivals gain strength while internal stability weakens, risk rises. But recognition allows correction. Empires extend their longevity by restoring balance, by earning more than they spend, by strengthening institutions, by maintaining unity. The same principles apply to individuals. Balance spending and income, invest in productivity. Preserve flexibility, avoid excessive leverage, treat risk with respect. The world ahead will likely look different from the one behind. But difference is not doom. Cycles are natural. Decline is relative. Renewal is possible. The story of history is not one of linear progress. It is one of recurring transformation. The clothes change, the technologies evolve, the pattern remains. Understanding that pattern does not provide certainty. It provides clarity, and clarity is a strategic advantage. The big cycle continues. One order matures, another rises. The question is not whether change will occur. It always does. The question is whether we recognize it early enough to adapt wisely. If this framework helped you see the world more clearly, consider subscribing. This channel breaks down historical macro patterns calmly, without noise, without sensationalism, just structure and perspective. And I'm curious, where do you believe we are in this cycle right now? Let me know in the comments. The conversation matters, because history is not something we watch. It is something we live. And the next chapter is already unfolding.